In the year 2000, one company was worth more than any other business on the planet. Almost $600 billion. It made jet engines, light bulbs, MRI machines, it even owned a TV network. And then, it quietly fell apart. This is the story of how General Electric lost its way. I've watched a lot of giants rise and fall over 50 years. But GE is different. This wasn't a fraud. It wasn't a fad. It was a real company, run by people the whole business world admired. For decades, GE was the gold standard. And that's exactly what makes its collapse so important. Because the thing that broke GE is hiding inside a lot of companies people own right now. Stick with me, the third lesson is the one almost everyone misses. Let's go back to 1981. A man named Jack Welch becomes CEO of GE. And over the next 20 years, he turns it into a machine. His rule was simple. Be number one or number two in every market you're in, or get out. He bought businesses. He sold businesses. He cut costs ruthlessly. They called him Neutron Jack. And the numbers were staggering. When Welch took over, GE was worth around $14 billion. By the time he left in 2001, it was worth nearly $600 billion. The most valuable company in the world. Wall Street worshipped him. His book was a bestseller. Every CEO wanted to be him. But here's the thing about empires. The bigger they get, the harder they are to actually understand. And that includes understanding them from the inside. Now, most people thought GE made things. Engines. Appliances. Power turbines. And it did. But quietly, GE had built something else. A massive financial arm called GE Capital. It lent money. It dabbled in real estate, insurance, credit cards, even subprime mortgages. And by 2007, that financial arm was generating roughly half of GE's entire profit. Half. The company everyone thought of as an industrial titan was really running a giant bank in the basement. Why does that matter? Because a bank is fragile in a way a factory isn't. A factory keeps making engines in a recession. A bank that borrowed short-term money to make long-term loans can freeze up overnight. And in 2008, the whole financial system froze. When the crisis hit, GE Capital couldn't borrow the cash it needed to operate. The mighty GE, the bluest of blue chips, was suddenly in real danger. So who came to the rescue? Warren Buffett. In October 2008, Buffett's Berkshire Hathaway put $3 billion into GE. But look at the terms. He got preferred stock paying a 10% dividend, and warrants to buy more. That's not a vote of confidence. That's an emergency loan to a company with no other options. He got greedy when GE was fearful. And then came the moment that said it all. In 2009, GE cut its dividend from 31 cents a quarter down to 10. It was the first dividend cut since 1938. Since the Great Depression. The aura of invincibility was gone. But the damage wasn't over. Not even close. The years after were brutal. GE kept making bets that didn't work. In 2015, it bought the power business of a French company, Alstom, for around $10 billion, a huge bet on gas turbines. Right as the world started shifting toward renewables. The timing was awful. Then came the symbolic blow. In June 2018, GE was removed from the Dow Jones Industrial Average. It had been in that index for over a century, the very last of the original members. Gone. And finally, the empire was dismantled for good. GE split itself into 3 separate companies. GE Healthcare spun off in 2023. GE Vernova, the energy business, in 2024. What's left, GE Aerospace, is now a focused company that makes jet engines. A good business. But a fraction of the empire it once was. So what's the lesson hiding in all of this? Here it is. The lesson of GE isn't don't buy big companies. It's this. Complexity hides risk. When a business gets so sprawling that even its own leaders can't fully see what's going on inside, that complexity isn't a strength. It's a place where danger grows in the dark. GE looked like an industrial fortress. But half its profits came from a fragile bank that almost nobody outside the company truly understood. Buffett has a rule for this. Stay inside your circle of competence. Invest in what you can actually understand. And if you can't explain in one plain sentence how a company makes its money, that's not a sophisticated investment. That's a warning sign. This is educational content, not financial advice, and GE here is a lesson, not a stock tip. But it's a lesson worth remembering. So let me ask you this. What's a company you own or you're thinking about owning that you couldn't really explain to a 10-year-old? Be honest. Drop it in the comments. I read them. And if this changed how you think about safe blue chip giants, hit subscribe. Tomorrow, we're looking at a company that did the opposite of G. It got simpler, and it won. See you then.